Hi, I'm Virginia Graham, author of Flirting with Finance and host of The Intelligent Property Investor. Today, I'm joined by Julianne Zammit, a senior broker at Finance on the Coast, to explore the finance side of property risk and how smart lending structures can prevent costly mistakes down the track. Welcome, Julianne.
Hi, Virginia. Lovely to be here.
But if we look at the first homeowners, we go back to that. So we go back to a first homeowner. They're in Sydney. They're looking for a unit to buy. What do they need to do for their finance to get ready?
Definitely get a pre-approval. That enables you to have something in place for when you're going out shopping for a property. It also takes you off the market, I suppose, in a sense, because then you know that a particular lender is going to be able to look after you based on the information submitted. Obviously, it is only a pre-approval, so the bank would still need to do a valuation. The other point I'd make is always get a finance clause, especially if you're a first-time buyer, because an auction scenario or even buying prior to auction isn't going to work because it's always under auction conditions. So we do need to have that finance clause so that we can value the property. Most banks would want to value it. And just a normal turnaround, settlement turnaround, I suppose, in New South Wales, as you mentioned, it's 42 days or 6 weeks. Often lenders can go quicker, but if you are a first-time buyer, and you might be applying for the scheme, the first home buyer guarantee scheme, then normally with a lender that might take 10 days to process to get you a reservation on that scheme. So the 42 days is normally the ideal time, turnaround time for buying a property and settling so.
And apparently there's 2 schemes now that we're talking about. There's a new one about to be introduced.
Yeah, well, that hasn't come into play as yet. The one that most people are looking at now is obviously in New South Wales, where you can buy up to $900,000 with as little as 5% deposit, and obviously the government will guarantee the 15%. Obviously, there's stamp duty concessions in New South Wales up to $800,000, and then they peter off or pro rata up until $1 million. So yeah, borrowing capacity is still based on what the bank's requirements are, but then with the first time owners deposit scheme, that's going to be based on the government requirements of what your income is, whether you're a permanent resident, citizen, and obviously not bought a property before or not in the last 10 years.
And what about guarantors?
Guarantors, lenders will accept guarantors, especially for first-time buyers, so mum and dad helping out. It's generally not for anything else. It is only a security guarantor, so not an income guarantor. So the customer would still need to be able to afford the full loan, and the maximum that you can normally borrow is 105%. So that would be 100% of the value of the property and 5% to cover the costs if the client didn't have any cash to put towards the property. How that generally is structured would be an 80% lend on the property that they're purchasing, and then there'd be a 20% guarantee by mum and dad on their home. And so it's a limited guarantee.
How would you get the guarantee? When could you apply to get the guarantee released?
As soon as you are at an 80% lend of the property. So if there was a valuation done down the track and the property that was being purchased was able to secure both loans and it was at an 80% lend, then you would do a partial release of the guarantor security. But it'd only be on that basis. And obviously there can't be any arrears or anything like that.
Yeah. And so with first-time owners, so say then they go the next step and they've released the parents as guarantors and they've got some equity and now they want to take the next step. At what stage in that process do they come to you?
They can, you could come, if you've got the idea that you'd like to buy an investment property, then you would reach out straight away and we could talk the numbers. I think the most important thing is making sure that you've actually got equity in the property, and equity in the property that you've currently got would need to be more than a 20% equity if you wanted to use some of that towards another purchase, because if you were borrowing more than 80% of the value of the property, then you are going to pay lender's mortgage insurance, or how we term it as LMI. So if a client did release the parents as guarantors and, you know, they've got their own property secured, you know, with their own loan, you would need them to wait a little bit until they're at least below 80% of the lend before they can use that equity.
And then is the reason that they come to you because then they can get the valuation done to work out what the equity is.
100%. That we would work out how much equity they've got. And because obviously Sydney properties and New South Wales prices are going up still now very quickly. But also the other side of it is making sure that the client can afford the loan too. So there's two things that we need to cover off. I mean, it's one thing having equity, but based on responsible lending, obviously the lender needs to know that the client can afford that loan as well.
And also what rent you're going to get.
And what rent you're going to get, which, you know, at the initial stage you might have an idea of what potential rent you might be getting, but then it's about the affordability.
Do a lot of people do you help people only in New South Wales, or can you help people Australia-wide?
I help people all over Australia. Obviously, lending is the same for me, regardless of which state a client is in. However, based on the state, there's obviously different requirements for stamp duty, different schemes that are available. Stamp duty in New South Wales is free up to $800,000, and obviously it does pro rata up to $1 million in New South Wales for first home buyers. However, in other states, that's not the case. So, you know, places like Victoria and WA and South Australia, it's a lot more expensive. So you are paying for that. So,
and regional areas.
And regional areas as well. Yeah. The other thing that is important is the different settlement timeframes. You know, each state is different cooling off periods in different states. So it's important that we're across that. So Queensland, it's normally a 4-week settlement period. They might have a longer cooling off period. However, based on how the market's going in Queensland, often places are going a lot quicker. So, you know, a lot of people may not be able to exercise a cooling off period in that particular state because they may miss out on a property.
If you're a rentvestor, could you still be a first homeowner?
I don't know that answer. I'd have to look at that one.
No.
Yeah, I'd have to have a look. If you've bought a property in the past, you would not be able to qualify for the first time owner's deposit scheme. But I've never heard of the term rentvestor.
Yeah, or someone who's renting and then buying an investment property.
No.
So you can't.
No, if you've bought any property in Australia, you do not qualify for any of the schemes.
Yeah.
However, if you haven't bought a property, let's say you've bought a property and sold 10 years ago, you could qualify for the first home buyer deposit scheme or guarantee scheme. However, you'd have to live in it.
We'd have to ask Kathleen, wouldn't we?
Yeah, we would actually. That's a very good question.
Yeah. We should ask Kathleen. What? Because that's something that we didn't think of, did we?
No. But good question. Yeah. We'll come back to that.
We might come back. Yeah. We might do a special
part 2.
Yeah, part 2. No, it's good to know all these things because there's a lot of things that you don't remember like that.
That's right. And a lot of my clients, I do have a lot of clients who are buying their very first properties, and it's super exciting to be able to help somebody get into their home, whether it be a unit or a townhouse or a house. And sometimes you have to, you know, explain to a client, this isn't your forever home. You know, this is your first property. And, you know, in Australia, a lot of people use their first property to start building up their wealth. So you may only be in it for a few years. But a lot of the clients as well are investors or downsizers. And occasionally you'll do the self-managed super fund loans, SMSFs.
So tell us more about the different loans then. So what about the SMSF loans?
Yep, do those. They're quite good. We do them for residential and commercial. There's a few lenders. Most of your major banks, actually, I don't know any major bank that does those anymore. So it's mainly the second-tier lenders that will do those loans. 80% lend on residential, cannot be owner-occupied, has to be rented out for obvious reasons because it's a self-managed super fund. If it's a commercial property, a lot of people do buy it where it's an owner-occupied, where they're renting it out to their business and their business is paying the rent. So they'll use it for office space or a factory space. And normally the loan amount to the value of the property is a 70% lend. And rates, you know, it would
be 70% anyway for a business, wouldn't it?
Yes, that's right. It's a 70% lend for commercial and business lending.
Yeah. quite often even 60 for some.
Correct. Depending on the location, sometimes the lenders might have a reduced LVR, maybe if it's in a regional area. And some of the lenders are very specific with postcodes for SMSFs, because if you are buying in a regional area or an area that is not metro, then they can often have restrictions on the location. So it is really important to check those, and maybe when getting a pre-approval for a self-managed super fund loan, regardless of whether it's commercial or residential, look at the postcodes of what areas you may be looking at, and then we check with that lender if they're happy with that.
That's good. And then what about investors? What's your best tips for investors?
Same as what I had for the owner-occupiers. So if you're looking to invest, think about, would I live in that property?
No, from a loan point of view, I mean. For investors, what tips would they have to look out for as opposed to someone living in it?
As far as what they're purchasing or loan options?
In terms of loan options.
Loan options, I look at the client's financial position. Sorry?
Because they cost more now.
They are slightly higher in rate, not by too much, but they are slightly higher in rate. But often I will look at the client's personal situation of if they've got multiple loans already, and whether they've got one income or two incomes, how much cash flow that they've got spare, and whether it's beneficial for them to be on interest only or principal and interest. So we would discuss different scenarios, and sometimes the client may have multiple investment loans and then decide, and they're all on variable with 100% offset, so they've got that flexibility to be able to put cash in the offset to offset that interest, and the next purchase they might look to do as a fixed rate, just to reduce the risk. Especially if there's a few things coming up in their personal situation that might reduce their income level for a period of time.
The other OCD side of me,
No,
I don't have it. It makes me kind of think, wouldn't it be cool to have like investment properties all with offset accounts so that all the expenses came out of the same account, so that all the accounting was perfect?
Yeah, it would be great.
Does anyone else think like that?
Yeah.
Is it just me?
Yeah. Well, a lot of the lenders now, well, not a lot, there are some lenders that have multiple offsets for a particular loan. So you could have one home loan and you can have like 9 offset accounts, and you can have them for various things, a holiday or a trading account or whatever, and they can be your offsets, and you're not earning interest, but you're saving interest off the home loan.
I just like the idea of when the rental property's there and the accountant comes and it's all in one account, all perfectly.
Yeah. I don't think that ever happens though.
No.
It's a good idea though.
Well, I just like the idea of it. I remember when Xero first came out years ago, and it was the first time you could automate your expenses and things, and I thought it was just fantastic.
Instead of getting a receipt.
Yeah. I thought it was great. Well, not just that, just automatically categorising your bank statements.
Yeah.
Things like that. And I just love the idea of, with an investment property, of automatically having all the expenses already on.
Yeah.
You could lose track of it though.
Yeah.
If you don't
so often, often people, when they're buying another property, they will have a second loan with an offset. So each property has its own separate savings account, and all those expenses and rents go into that individual account. And that can be the offset for that particular one.
Yeah.
And even if you might have heard of the term cross-collateralising, where you're using equity in a property to buy the next one. So your first one you might have bought and there's plenty of equity in that property, and a client might borrow 100% plus cost by tapping into that equity. So they're cross-collateralised. But it's still a second loan or a separate loan. So you can keep those expenses separate.
Which is great.
Yeah, yeah.
Especially for my OCD that I don't have.
Yeah, and you can nickname them. You can, So
yeah, no, it's good.
Yeah.
I noticed that too. They call it nicknames in the bank portals, don't
that's
they?
right.
Yeah.
And often with the bank statements, they will itemise the different expenses that you can change in your internet banking app to reflect certain expenses, which is good.
And what about for downsizers? Do you see much of that?
Probably not as much. I think that will become more prominent in the future, because obviously people, the population's getting older, and people with bigger homes and, kids moving out. I mean, I did that. I had a huge home.
What do you mean? You're 21.
I had a huge home with 7 bedrooms and the kids all moved out, and then we downsized and bought a unit, and it was the best decision ever. Now we live by the beach. So, and the mortgage is smaller. But you do see that where clients are wanting to not only downsize but also diversify, and they'll use that money to then buy some investment properties or put money into their super and just tap into the equity. Yeah,
that's what I've been seeing, is the people that are downsizing are buying other properties as well. Yeah, not always, but I probably wouldn't see them if they weren't, because they just pay their loan out.
Yeah.
Yeah, no, it's good though. I think it's good to diversify the risk. And the other thing that surprises me is they downsized, bought 2 cheaper ones, but they both went up faster than the house had gone up if they just kept the house. Because I remember once I used to work for this accountant I was also an accountant, don't tell you that.
No.
Yeah. I had so many jobs. I feel like I'm a Barbie doll or something. 100 careers. I used to work with this accountant, and I used to work doing tax, and it was so boring. It was the days before the internet, it was like really boring. You had to manually check everything, and they were always wrong. And I had to pretend they weren't wrong and wait till the guy went out and then show the people, and then it was so bad.
Oh, you're good.
Terrible. And but his whole thing is, he's an accountant. He wasn't an investment advisor. I don't know why everyone took his advice. And this is not advice, by the way. This is just what he used to tell everyone. He'd say, go and buy 4 units by the train station or something. And they were always these horrible units, probably terrible ones, didn't get past, didn't do anything it was meant to do. But they used to go up in value so much, because 4 or 5 2-bedroom units would go up faster than the houses. Yeah, and that's what's happening with a lot of downsizers, because so many people now are downsizing.
And when you think about it, it's like you've got, 4 lots of rental income, or 3 lots of rental income if you're going to live on one.
Yeah.
So,
it's less risk. You can sell one. It's easier to sell them down.
Yeah.
When they're little ones like that.
Yeah. And I think too, one of the things that I do say to clients that are coming to buy their first home is, because often they'll try and get as much deposit or savings as possible. And, I'll say to them, and again, it just depends on the person, but it's very hard to save the 20% deposit, especially in nowadays. It's just, the way that the prices go up. If you're looking, especially in New South Wales, if you're looking to buy something for $800,000 to get the stamp duty concession of no stamp duty, you literally need $160,000 deposit to avoid the mortgage insurance. But, under the scheme, especially if you've got the opportunity to take it up, you can get in with as little as 5 or 10% and have the government guarantee. And, the spirit of the scheme is to allow people to buy their very first property. So you need to live in it. You need to live in it for at least 12 months to get the stamp duty exemption. And then you also need to live in it for as long as it takes to have the loan to value ratio at 80% under the first home buyer guarantee scheme. So it is a great program to get people in to buy their first property. It may not be your forever home, but, if it allows you to buy in a market, it may not be in the eastern suburbs, but if it allows you to buy a home for your family, then it saves you a lot in rent. We all know what rent's doing nowadays.
Yeah.
Increasing.
Crazy. And also seeing all the lines of all the people waiting, trying to get the rent.
I know. And I, we don't have a crystal ball, but it's not going away. The government cannot build them quicker. And, the current government's clearly hasn't done that.
Yeah. Or the former ones.
Yeah.
None of them have done it.
Yeah.
Yeah. And no one knows what's going to happen next. But I think definitely, if you're able to get in, I think people
at least have a conversation to find out what's possible, because you might be surprised.
Yeah.
You're closer than what you think.
Well, thanks, Julianne. That's brilliant advice for anyone who wants to get their finance structure right from the beginning.
My pleasure.
That's awesome. I think what we might do is have a little one more second with Kathleen, because we had one more question. Do you want us to come in at the end? It doesn't matter if it's all. Yeah, we wanted to ask the one question that we had. Should we ask the one question?
Yeah.
What was it again?
Can't remember.
No, it was about. Yeah.
Let me just say it.
Yeah. Well,
If
come
you-
over here, though. Come over here. You got to come over to the seat. We got a little tidbit from Kathleen here.
Once you have owned a home as an owner-occupier in your name, you cannot get it again unless you bought it under a company.
Yeah.
If you bought your first one under a company, you can usually get the first home buyer concession for
That's the New South Wales one.
Yep.
Yeah. And this is not advice, it's just general in nature, but that's generally how it works in New South Wales.
and things change all the time.
Yeah. That's good. I knew there was something we should have asked you.
There's so much to property buying. Really have to get into it.
Yeah, there is. Is there any other tips like that we've gotten to ask you? Things that people don't know? Because that's something we don't even know, and we see it every day. Like,
I think Julianne covered a lot as well. Cooling off for first home buyers, that's
Yes.
important. More time for us to do our due diligence from the contract and building pest strata perspective as well.
yeah,
And next time they know what they're in for.
yeah. That's great. Thanks, Kathleen.
Thank you.